Well, hi. I thought I'd record the video here. We're just going out for some lunch shortly. We want to talk about natural gas and a couple of other things. This is the South African winter. This is our new flat. So this is the view from our sort of balcony area. It's beautiful. So we're very happy, and I can quickly rush you a video before we go out. So that's pretty cool. And I can do it in the sunshine in a rather chilly day. As you can see, I've got sort of wrapped up a little bit warmly. Let's start with natural gas. So I've got that on the chart right now. This is the 4-hour chart on my broker, Natural Gas, Black Bull 4-hour chart. And remember, the rollover is on the 27th or the 28th. Keep that in mind. We'll come back to that shortly. But look what happened. We surged through this trend line, this channel line top, with a big 4-hour candle into this pink resistance zone. And you can see I've got the Fibonacci levels on there. I've actually just changed the Fibonacci levels and made it from the top down to this recent low, from the $3 level down to just below $2 at $1.94. And what's interesting is we got through this resistance zone with that big surge higher. But this green line that we touched is actually the 78.6% Fibonacci level. This line here is obviously a very important Fibonacci level, and it's kind of the last chance for this trend to reverse before it goes back down again. And we just about touched that green top Fibonacci level at the 78.6% fib level, and then fell back down from there. Now you might think, okay, well, we've rejected from that fib, that's the last chance fib, and fallen back down again. But we've just fallen down to the bottom of this pink support zone and the 20-period moving average, which is down here. And we bounced off that late in the day on Friday after we got the rigs report, which showed a decrease in the number of rigs, and that was slightly bullish for the price of natural gas. Overall, I still remain bullish up into the $2.90 region and then the $3 region. If we get to $2.90, $88.90, we could just surge through there into this liquidity gap up to $3 and then potentially reverse. I think we've got to test the top of this channel line, and as I said in the previous video, that line coincides with the $3 level in a few 4-hour candles time, and we get up to there right around where these two lines meet, the channel line and this $3 level. But it's also where the monthly contract rolls over. If I hover this mouse over here, you can see that's on the 26th of July, and we'll have a look at the NYMEX chart just now to show you when the rollover is. Remember, we're long from down here at $2.51. We have a half size position. Actually, on Friday, when we formed the spike high, first of all, up to that Fibonacci level, I took off half of that half position, leaving me with a 25% long. But then when we saw support, I got back into that trade. We seemed to hold that support, moved back up again, formed a double top, and then moved back down to the support below us down here at the 20-period moving average and the bottom of this pink support zone. So that's where we are at the moment, still holding above there. And below us, we've got all sorts of support levels, which I've outlined in previous videos. That would first of all be the top of this downward channel line at around 265. There's every chance of a breakout through a channel line that we come back down to the top of it, retest it and bounce off there. That would take us down to this Fibonacci level here at 260 to 65. And we've got 250, and we've got 245, and then even below that we've got 235, and all the way down to 215, which is right the way down at the bottom here. So we've got all sorts of support levels below us, but overall the trend's up. We can see that more clearly if we look at the day chart. So let's switch across to the NYMEX day chart. I've got Peanut the dog just wandering around at my feet. Here's the NYMEX day chart. Hello, Peanut. Get down, get down. So you can see the overall trend is bullish. We've had a number of days with higher highs and higher lows, just moving up, first of all, through that yellow resistance zone, breaking above 267. There's a motorbike or car banging behind me right now, and holding above there, and that level there coincides with that support line and the 20-period moving average on the 4-hour chart. It's also the 20-period moving average on the day chart. So overall, as long as we're above all the 20-period moving averages on the longer term, the day chart, and also on the 4-hour charts, then we're looking pretty good. The move upwards is still intact and we're still looking fine. There's the $3 level above us, which we saw on the previous chart, and there's that liquidity gap where we gapped down on the last attempt. Now that last attempt was shortly after the rollover. In fact, on that rollover, we saw a 3-gap move up. We had to close those gaps, which we did when the price moved back down again. And we closed all of those gaps. Actually, it's only 2 gaps. And fell back down here, and since then we've been steadily moving higher. When we look at the fundamentals of natural gas, it all points to a continued move higher. I'm actually having a live session with Brian this week over at Energy Rogue, and he'll be able to tell you a little bit about the supply and the demand situation. He's a man who's actually been in the gas industry for a very long time, and he's much more qualified to talk about those sorts of things. But his idea is also that the supply-demand situation, the seasonal variations, and the temperature changes that we've had recently with heat surges in the US and across Europe and Britain, all of those contribute to an overall bullish picture on natural gas. So far, so good. What I wanted to point out on this chart was the rollover date, and that is over here, the 27th of July. That's in a couple of days' time. It's the 23rd now, it's Sunday. We're going to see the weekend open in a few hours' time, and we'll have to see what happens with that. Remember, if we look back at that previous chart on the 4-hour chart, That's also where these lines are likely to meet together. If this chart begins to move up towards $3, and the timing of that would actually be on the day before the rollover. So that's really interesting. I don't know if we're going to get up there or if we're going to collapse back down through here, down into support levels below us, potentially even down to the bottom of this longer term channel, and that's way down below us, down into the $2.45 region. So there's a possibility that that could occur as well. But as I said, overall the fundamentals are very supportive of natural gas rising higher in price, and we should see a move higher rather than a move lower. So that's the overall picture. I'm long from $2.51, aiming for $2.88 or 90, and a breakthrough there up to $3 through that liquidity gap to the top of this channel just before the rollover, and then we'll have to decide what happens at $3 if and when we get there. Overall, my target towards the end of this year is at about $3.40, 50, 60, or 75. As you know, when we look at the day chart, sorry about the car noise behind us, I think Sunday afternoon hooligan races. But when you look at the day chart, you can see that's the problem with living on the beachfront. It's very, very beautiful and very nice. You don't mind the traffic so much because it is a beachfront, but sometimes there's a little bit of noise. Not so much at night, but on a Sunday afternoon for sure. You can see the 200-day moving average just beginning to move into the center of that resistance level at about $3.50. It's now at $3.65. If and when we do get there towards the end of the year, that will probably start to flatten out and average out at about $3.55 or $3.60. The 200-period moving average on all charts, whether you're looking at commodities, currencies, metals, stocks, is a very important and key level. So if we do get up there, that's certainly going to form some resistance to price moving higher. So that's where we are on natural gas. Let's see how this market opens a little bit later on today, and we'll have to play this blow by blow and see how this price reacts, remembering that our overall idea is that this will move up towards the top of this channel at around $2.88 to $2.90 and potentially $3 at the top of this channel line before we see some sort of correction back down again, and then eventually up into 340, 50, 60, or 75. But there is a chance that we could move down even towards the bottom of this channel, which is now at about 245, and on a break below there, well, that would be pretty bearish for natural gas, and a break through this longer term rising channel wouldn't be very good news, and we'd then have to allow for a move down to 215 again. That's not my preferred view on it. I think we're going to see higher rather than lower initially, $3 being the target. So that's natural gas for you, and I'll update you as time goes on. If you haven't subscribed to this channel, please feel free to subscribe to make sure you get further updates as time goes on. And also, if you've enjoyed this content, please give the video a thumbs up. That would really be appreciated. It helps the algorithms point viewers towards these videos. That's the way it works on YouTube. Let's have a look while we're on this chart at WTI. We're stuck underneath 200 period moving average on the day chart on WTI. You have to be very careful when trading oil. It's subject to all sorts of issues that go on in particularly geopolitics, economic conditions, and manipulation by providers and suppliers of oil like the Saudis and OPEC and various other countries involved. And these prices can move dramatically one way or the other, as you will have seen, for example, by large gaps like this in the middle during that OPEC supply cut scenario. We also had the situation when WTI dropped below zero at one point. It was on April the 21st in 2020 when the price actually dropped below zero. It's not reflected on this chart. It stops here at $7 or $8. It caused all kinds of havoc with open positions on futures and options, and brokers not even having the ability to price commodity in negative numbers. So that was chaos. A lot of people lost an awful lot of money during that scenario. So just remember that this is a potentially very dangerous and volatile commodity to trade, and you need to be super careful. But for the moment, as long as we're holding above roughly $65, the price should begin to move higher and eventually break down through some of these downward facing trend lines and move up potentially into the triple figure range, maybe above $100, starting at around about 85, moving up to around about 95, and then potentially breaking through $100. A lot of it depends on economic conditions, and we're seeing some very bad signs in the economies around the world, which will definitely put pressure on the price of oil. But we've also got pressure coming from the other side with production and supply manipulation by oil producing countries and organizations like OPEC and Saudi, and potentially even Russia too. So all of that's going to be a kind of a mishmash of moves up and down. For the moment, I think we're kind of stuck in this range between 65 and 85 for the foreseeable future. We'll have to watch that one very carefully. When it comes to other commodities, nothing much. We're looking to sell sugar eventually. We're getting into that selling zone for sugar. We've closed this gap above us, which was the first target. Actually, this is an interesting chart for those of you who like to trade sugar. You can see these two gaps that were formed on the way down. We had to close those. We closed the first one a few weeks ago. We've just closed this gap here. And we've got another gap above us between 25 cents and 26 cents per pound. That's this gap here. I think we're going to have to close that one too. This close on Friday looked pretty bullish. We are at the 61.8% Fibonacci level. I'd like to start selling sugar at the 78.6% Fibonacci level once that gap is closed. And that would be around about 26 cents per pound. So look for that level on sugar if you're a sugar trader. I'll certainly be looking to start taking some short positions around about 25.90 to 26 cents per pound. So that's sugar. Soybeans, the same thing, by the way, looking for a move a little bit higher. But the other thing on here that's interesting is Bitcoin. I want to have a look at Bitcoin with you. We're short on Bitcoin. We took a short position 2 or 3 days ago, having failed this moving average here. This is the 20-period moving average. Now holding beneath that red support line on a few consecutive days. We also saw this failure at the top here, breaking out and holding above this red resistance line at 31.5. 31,500. We actually closed above there. That would have actually drawn a lot of long traders into Bitcoin, only to be trapped the very next day by a huge move down and then a gradual dribbling downwards down towards the support and closing beneath the support level at around about $30,000 several days in a row, just forming slightly lower highs every day, holding beneath this 20-period moving average. We're short on Bitcoin, with a target of around about 27,800 to start with. Probably 25,000 is the perfect place to exit. If I draw a line across there, you can see why. It's a previous support level there and a previous resistance level here. It's also right in the middle of this downward sloping channel that we broke out of a number of days and weeks ago now. This has been a very long period of consolidation. The fact that it hasn't actually surged higher means that this bull flag, potential bull flag, has turned into a rather weak and insipid channel, and certainly not a bull channel. It's looking very weak after having trapped those long positions high up there at 31.5, 32,000, and now falling back down and closing beneath this red support line at least 2 days, maybe 3 days in a row, and making lower highs beneath the 20-period moving average. So we're short on Bitcoin, and I think we could see 25,000 in days and weeks to come. So that's all of those on those charts. I'm going to look at gold very quickly. We're long on gold from quite low down on this chart, and just holding above that support level. This is a really key level at 1,950. See why? It's a previous resistance level. It's a consolidation zone around here. Supply and demand sort of mix and match sort of zone. Was a bit of support over here as well. It's a pretty key level. If I scoot back on this chart, you can see going all the way back into 2020, this sort of green area here is a very key level. We're just testing the top of that now and holding above it quite neatly. We did test this 38% fib level down here at about 1,900, just slightly below it. We bounced off there beautifully. We got long quite early on, and quite a long time ago now, a number of weeks ago in fact. That surge higher is very encouraging. All this has done is, over the last couple of days, is retrace back down to this breakout level, which is quite normal. And if you're looking to get long on gold, this is possibly not a bad idea to start nibbling at it. There is news on gold in that there's been a lot of gold buying recently. A lot of funds are buying into gold, and continued central bank buying of gold. So generally the market's quite supportive. And I think we could get up to the 2,000 level again, back up to the top of this channel line, about 2,040. And then a 2,070 or 80, and then a move eventually to break up to new highs. So that's our overall idea on gold. Pretty long on gold. I've got a good healthy position on that. The other one is URA. While we're talking about metals, and I keep on repeating uranium is actually a metal, even though it's a fuel, which is kind of weird. But here we go. We're at the bottom of this green support level, just broken beneath it. But right below us, we've got a little support level there, formed by that low. We're still above there. Overall, I'm pretty bullish on uranium, and I think there's been a lot of interest in uranium energy. There's a lot of building of nuclear power plants and a resurgence of nuclear power plants all over the world. And I think this is undervalued. After having formed a beautiful repeated bottoming along this level at around $19, we haven't moved up very high from there, so there's still plenty of opportunity to buy into uranium. And I think we've got to get up to the top of this range at some stage, $24, $24.5, and then a move up into about $28, and then eventually a move up to around about $30. So you can see we've got this little downward trend line that we've got to get through, but we have broken down through this long-term downward trend line. We've broken up above there, successfully tested it from the top, and we're holding above there for now. So that trend line is broken. We've now got to break the range. The top of the range is at $24.50-ish. And then the next stop from there is pretty clear. There's not much resistance until we get up to about $28.50. And that's right up over here. So that's the overall plan for uranium. I've got a healthy position on that too. I would like to talk about stocks very briefly, but I've covered this a lot in recent videos. And also I've covered it on my Twitter channel. So once again, if you're interested in this sort of thing, why not subscribe to the channel and give this video a thumbs up, because you'll get all the information I put up on stocks and stock indices. We're short across the board on most of these. We're short on NASDAQ from near the top. We're short on S&P from near the top. We shorted NVIDIA a couple of days ago. That's moving down into this trend line. and I'm going to pick out one of these just out of interest. I think we could get a 10 to 15, maybe even a 20% retracement across the board on all of these names, particularly the tech names. There seems to be a flow and a rotation out of tech names into what I call the stocks that your grandfather used to buy, stocks like Ford and oil stocks and John Deere and Walmart and that sort of thing. There seems to be a move into that, and perhaps even, funnily enough, into banking stocks. So I think there's going to be more of a potential dip in the tech stocks, as these are sort of very overblown, overvalued. I think some of the hype over AI and its potential is dwindling a wee bit, and I think we could see these pull back. I don't think it's all over for tech stocks or chip stocks or anything to do with AI. I don't think the story is finished by any means, but I think we do need some retracement, at least to some of the moving averages, and we could look at some mean retracement therapy going on here. But let's have a look at NVIDIA. There's the moving averages below us. We're touching the 20-period moving average, which is where this short-term trend line, we're about to test the short-term trend line, and we've got the 50, the 100, and the 200 way below us. I think we could get back down to perhaps the 100-period moving average. I think we're going to, at some stage, have to close this gap here. And the gap is between $375 and $318. I think we're going to have to close that gap. What's interesting is that the previous all-time high is slap in the middle of that gap right there. So we're probably going to get a bounce off that previous all-time high back to the top of the gap if we ever get to these areas, and possibly a little bit further through that, and then eventually a breakdown through the previous all-time high to the bottom of the gap. And that's where I'd look to exit any short positions on NVIDIA at around $320. Remember that if a gap is attacked and approached and eventually penetrated on stocks particularly, those gaps are normally closed completely and not just partially. So even though the all-time high is right in the middle, we're going to have to at some stage probably break through that all-time high, get to the bottom of the gap to fill this huge earnings gap that we experienced when the price moved up, I don't know, it was 20 or 30% in a matter of hours. Well, actually, it was an overnight gap or over weekend gap. I can't remember. So first of all, we've got to get through this trend line. Now, so we've got this little gap here. We've just touched the bottom of that gap. So we might see a little bit of a recovery earlier on the week. But I think we might have formed an intermediate high here. So as long as we're holding below $480, we should see an attempt to get through this trend line, the 20-period moving average, and then move down to the 50, test the top of the gap, which will act as support. We'll get a bounce off there probably, and then eventually a retest of the gap, a move into the gap, test of the previous all-time high, a bounce off there, and then eventually a move back down to the bottom of this earnings gap at around $318 to $320. And that's where this long-term uptrend may resume. So that's my overall idea of things. Anything could happen, and a lot of people are kind of bullish on AI and chip stocks still, and people don't believe that these are ever going to retrace, but the markets always do retrace at some stage. Whether it's going to be now or whether we've got to make new highs first, I really don't know. If you're going to be trading this short, you need to be prepared to hedge this at some stage or exit your trades at a stop loss and then look to resell at a later stage. So overall, that's the idea on stocks in general. I think we're going to be 10 to 15% short on S&P and NASDAQ, and the same across the stocks. We've seen Microsoft, we've seen Tesla, we've seen Netflix, Apple, AMD, and NVIDIA we've talked about all coming off. So generally, we're short on these. If you want to get specific details on how we're trading these on a day-to-day basis, you can go across to my website and join our community. There's a 30-day trial. If you don't like it, you don't enjoy it, and you don't get maximum benefit from it, you can cancel and just get all your money back. So there's no risk to you. You can try that out if you want detailed descriptions of what trades we're taking. Right, now let's go and have a look at the yen pairs. They're all very interesting. We've got this prolonged move down on dollar yen, on euro yen, on actually across the board on most of them, all except for Swiss yen, which only dipped a wee bit down to the support and this trend line down here. But overall, these all moved down, and actually dollar yen formed a lower low, and we've moved back up into this pink zone. They've all moved back into resistance levels at the moment. We're now short again from the top of these pink zones across these charts. There's a very interesting chart on dollar yen, and I'm not going to talk about all the yen pairs because there's a fact that when the dollar yen moves down, all the yen pairs tend to move down at the same time. So it becomes a matter of yen strength across the board rather than just against the dollar. So whatever happens to the dollar yen generally translates into the other yen pairs. And if we have a look at the dollar yen, there's a very interesting chart here. I want to compare this move down recently to the last move down from around about $152. We had a little bit of intervention from Bank of Japan, first of all at 152, and then at around about 145, the top of this green zone here, that pushed this price way down into this pink zone and this red support line. That was November 2022, so 6 or 7 or 8 months ago. Now, what's happened this time is exactly the same thing. We've moved down from the top of this green zone, like we did in November last year, down to this red line, like we did in November last year, and we've bounced back up to this black line, sort of slightly into this green zone, exactly like we did in November last year. And you can see in November last year, the candle that took us up into that level, the rally that took us up into this level here, actually formed a tweezer top, with the very next day moving down and starting off a new downward trend. What we saw on Friday was exactly the same thing. Strong bullish candle with a very tiny wick, just like November. There's the strong bullish candle with a very tiny wick. And we've moved up to precisely the same level, right there, that black line sort of slightly into the green zone. It's also where the 20-day moving average is curling downwards. Remember, we formed a lower low on this move below that previous support. We've moved down, bounced off exactly the same level, having formed a new daily lower low. We've also broken down through this rising trend line. We've broken back above it, but we've only broken back up to that resistance level that we saw before and the 20-day moving average. And there's every chance that we'll form another tweezer top like we did the previous time, and then move down, back down through this trend line, and then move down towards 138 again, and eventually break through down towards lower levels. That's exactly what we saw in November over here. Same sort of thing, rally back up there, a breakdown, bouncing off that low there, the red line, a little bit to start with, and then eventually breaking down through it, retesting it from underneath, and moving down to lower lows at around 127. That's my eventual target for dollar yen, the bottom of this move at around 127. Now, I know that the Bank of Japan has just stated that despite their inflation problems, they're not planning to adjust their yield curve. But there has been rumor and some leak that actually that may be a little bit of a bluff, and that they could be considering adjusting their yield curve. And the moment they do that, we'll see a big surge into the yen, out of the dollar. I think if that does happen, we'll see pressure on the dollar, and we'll see an inflow, a strong inflow into the yen, which will pull all the yen pairs down, including the dollar yen, the euro yen, the pound yen, and all the other yen pairs down towards the levels at which they should be trading. And that includes the dollar yen, as I said. And my target for dollar yen is all the way back down at 127 again. And I know that's a contrarian view, but I think there's a strong possibility of that happening, and that's the way I'm positioned on dollar yen. We'll have to see how we go. We don't want to see this moving any higher at market open tonight in a few hours' time. Let's hope that we do see that scenario playing out. And as I said, that's going to affect all of these yen pairs across the board. And I'm trading dollar yen, euro yen, pound yen, Aussie yen, Swiss yen, and CAD yen. I particularly like the Aussie yen, the CAD yen, and dollar yen. I'm not too sure at this stage yet about the euro, the pound, and the Swiss, the European pairs, but I do like CAD, Aussie, and dollar against the Japanese yen for all of these pairs to move down in coming weeks. Last thing I want to look at quickly to finish off is the euro and the pound. I'm just going to very briefly say I'm long on the pound and the euro. My target for the euro is 1.16. My target for the pound is 1.33. There are several reasons for that, but very simplistically and very quickly, the euro is in a long-term downtrend. We're constantly making lower lows and lower highs, and every time we get to the bottom, we move back up to this long-term weekly trend line, which is now at around 1.16, and it's also this previous pink resistance zone, and I think the euro is going to move up into there as we see further dollar weakness, particularly if we get that yen intervention by the Bank of Japan. And the same sort of thing on the pound. We've got this long-term downward trend line, and I think we've got every chance of the pound moving back up to test that trend line. We've got quite close on the pound, and we have to be a little bit careful because that might be close enough. But overall, I think we're going to see dollar weakness, considering as well that the US might begin to stall, pause, or slow down on rate hikes ahead of the European Union and ahead of Great Britain, and therefore put pressure on the dollar through the interest rate differential. Well, I hope you found all of that useful and enjoyed the view from behind me of the beachfront here in Port Elizabeth. If you've enjoyed the content, please give the video a thumbs up and consider subscribing to the channel if you want further updates as we go along. Take care. Have a great trading week ahead of you. I'll speak to you soon.